Nosotros despedimos a Alberto Iturralde, que siempre nos da lecciones sobre ese sentimiento, cómo detectarlo, cómo leer las noticias también para saber qué nos están intentando vender y también no creernos todo lo que leemos por ahí. Vamos ya con otra entrevista, en este caso internacional. Antes les decíamos PMI del ISM. Bueno, pues tenemos aquí al chair del ISM, del PMI manufacturero de los Estados Unidos. Timothy Fiore, chair ISM Manufacturing PMI. How are you? Thank you for coming.
Thanks for having me.
So, what assessment can we make of the ESM manufacturing PMI data, which came today at 46.9? It was below the last month and also below expectations, right?
Yes, slightly below expectations. I think the consensus estimate was 47. We came in at 46.9. So let me talk about the positive stuff first. The biggest positive is that the production number at 51 and some change really reflects the fact that billings, revenue for the manufacturing economy actually expanded in the month of May compared to April. You know, slightly, not a lot, but it did. Supported by new export orders that were stable month to month, which has been a long time concern here about Europe and China really re-engaging in the market. So that's a positive thing. From a higher fire standpoint, employment numbers were above 50, which means that we're actually expanding our headcount, not a lot, but expanding, and more importantly, we're not declining the headcount. So if you're a demand advocate, then that's a good number. If you're looking for the trough, inflation is still too high, that's not a good number. But in any event, from a manufacturing standpoint, employment expanding, production expanding, that means revenues expanding, all good. The other good things that we had in the month was our prices came down. Prices are still high. The Federal Reserve is still looking for price growth to stop, and having prices come down in the manufacturing economy is a very positive thing. Another positive factor is lead times. As I've been saying for several months now, lead times of suppliers are not budging, which means they're most likely overstated. The last analysis we did indicated they were 30% above trough levels. So in the last couple of months, the panelists have commented that lead times are coming down, but our numbers that we report were not moving much. Well, in the month of May, the comments were overwhelmingly about lead times coming down, and the numbers actually support a 6 or an 8 day decline, which is about an 8 to 10% drop from the month of April, which is all really good. So, you know, I think the good thing here is the mechanics around manufacturing are in the best position that they've been in since the pandemic, meaning we've got enough labor on the factory floor. We're currently supporting a pretty strong revenue stream. We have suppliers delivering faster than they've delivered probably in the last 15 years. There is not a lot of manufacturing inventory being retained by our panelist companies, which means they're managing input very closely. And we have lead times dropping. So the mechanics around manufacturing are really good. The not so good part of the story here this month is that although demand has been gone for quite some time, meaning new order levels, we've had 9 months of contracting new order levels. That by itself was not a bad thing because we had all over-ordered during the pandemic, meaning that we probably placed 200% of our normal lead time just to make sure that we got in queue so that when it came time to deliver, we had an order position to take the delivery. We've been working off that over-ordering now for the better part of a year. The biggest concern in the report is that the backlog number is the lowest number we've reported since the Great Recession in 2009, which kind of says that we've consumed pretty much a big part of our overdue and a lot of that backlog. And at some point, you have to wonder, what are we going to work on? And that's kind of where we're at now. So we've kept the labor that we thought we needed for the second half of the year. We've managed our input material at an acceptable level to the point where our manufacturing inventories are actually contracting. The question now is our customer demand. The customer inventory number reports that we're at the low end of too high. So our customers have enough of our inventory for sure, and maybe a little bit more than they really want. So we need the new orders to come back in to rebuild the backlog, because you don't invest in capital equipment and expanding your headcount unless you have a decent amount of backlog. And by now, after a year and several months of burning off that backlog, we're finally at that point where we need more inputs, which means we need more new orders.
That's very interesting, Timothy. And do you think if new orders continue to contract during the next months, maybe manufacturers are going to start, unemployment could rise and manufacturers start to lower that production also? Because if new orders continue to decline, it means we can even be in a recessionary mode, right, in manufacturing?
Yeah, so let's kind of assume that, we had a 51 on the production, which means we had, good billings compared to April, and, we're very stable. So what you could argue now with backlog being consumed so much, new orders being so weak, that our production number will drop in the month of June without new orders. So, think 47, 48. When that happens and no new orders are coming in, we're going to need to address the headcount, because we're going to have to finally decide that our workers that aren't working on the factory floor can only paint so many machines and paint so many floors and do so much brush cleaning. And at some point, we're going to have to decide to let them go. This is all going to happen at the end of June, when we close the first half of the year, the second quarter. Companies are going to have to really look at the balance of the year and decide whether they have too much headcount based on how much orders and backlog they have. So I would say that in the last 4 weeks and for the next 4 weeks, there's a huge amount of effort by salespeople at supplier levels and buyers at our panelist levels to figure out, okay, what order streams do we really need given the best case scenario and the worst case scenario, and come up with the right scenario so they can decide what to do, and they enter half two. If you recall, the panelists had said on the forecast that half one would be lumpy, but half two would be a lot better. When we updated the forecast in May, that got moderated quite a bit. The feeling was more that maybe Q4 will be better than Q1, Q2, Q3. In this month, I got quite a few comments that indicated that the quote so-called recession might continue on into 2024. Well, we haven't really had a recession yet, so first you have to start a recession in order to end it, and we haven't started it yet. And this is all really a function of a soft landing. With a soft landing, there's a lot of benefits to that. You get plenty of time to manage your order streams, manage your inventories, manage expectations. At some point, when you're not sure what the future demand looks like, you're going to have to start cutting your capital budget, start to think about consolidating facilities, and then ultimately start to think about laying off people. In the next couple of months, we're going to see all of that come to play. The mechanics around manufacturing are perfectly positioned to allow those decisions to be made. We're missing demand primarily because of the uncertainty in the economy, primarily because of inflation. So we'll see what June and July brings. I think we're finally at that point now where we're going to be able to do something different.
We're at crossroads right now, right?
Yeah, whether it be letting people go or keeping the people and maintaining some growth level on the production side.
Very interesting. We'll see in June and July. And finally, Timothy, I want also to ask you about, with these all numbers on the table, what do you think the Federal Reserve is going to do on June? Harker and Jefferson yesterday already say that maybe a pause could be on the table. What do you think?
Well, I would go with the consensus, and the pause is probably appropriate. The banking turmoil hasn't resulted in a lot of constraints on liquidity from what I can tell from the comments coming from panelists. And I think the general economy, you haven't seen a great run on banks. I don't think they've managed that well. So they've been thinking that was probably a headwind to growth, a positive in terms of rate growth. But I think, with everybody saying, well, it takes a long time for rates to actually come through to the real economy. That's why the Fed is using the super PCE number now, which takes out energy, takes out food, and takes out real estate costs, because real estate costs take a long time to kind of be realized too. So, but I think the super PCE is still somewhere around 3.8, 3.9, which is well above that 2.5% target of the Federal Reserve. So, a prudent person would say, okay, let's pause in June And I think there's probably a meeting in July, or there's one in August. I think there's a big Jackson Hole meeting in August. Maybe a positive is appropriate, but you start to make the argument that what is good here, and good is defined by a lot of different things, is a slow landing good. The counter argument to that is that it's leading to a huge amount of uncertainty about what the future looks like. Versus a hard landing, if it was a hard landing, we would be in that hard landing at the trough already, and we'd be starting to talk about recovery. We're not even in the bottom yet, which is, and with business, uncertainty is its worst enemy, and we're now a year into uncertainty. And the longer this goes on, the more uncertain it looks.
So thank you for your analysis, Timothy. The longer this goes, the longer this uncertain becomes. Thank you for your time, Timothy Fiore, Chair, ISM Manufacturing, PMI. As always, it's a pleasure to have you here in Negocios Televisión.
Thanks for having me.